Welcome to the channel, guys. Today we're talking about investing, specifically the 7 best ways to get started with the stock market, even if you're totally new to this. We're going to break down some key strategies to help you build a solid foundation for your financial future, whether you're just starting out with a few bucks or looking to level up your investing game. I'm talking about minimizing risk, maximizing returns, and making sure every dollar you put in is working as hard as it possibly can. Let's get started. All right, so you're ready to start investing. Where do you even begin? Well, for absolute beginners, I always recommend starting with index funds. Think of index funds like the all-star team of the investing world. They're like these big baskets of stocks that track a specific market index, like the S&P 500. Instead of trying to pick individual stocks, which can be risky and time-consuming, you're essentially buying into a diversified slice of the entire market. What's great about index funds is that they're super low cost too. You see, when you buy individual stocks, you're paying fees for every single trade. But with index funds, you're only paying a small annual expense ratio, which is a percentage of your investment. Index funds are like the set it and forget it method of investing. You can automate your investments, so you're consistently putting money in and then let the market do its thing over the long term. It's a simple hands-off approach that's perfect for beginners. Now, once you've dipped your toes into the market with index funds, it's time to talk about diversification. Remember that old saying, don't put all your eggs in one basket? Well, it's true in investing too. Diversifying your portfolio is like having a backup plan for your money. Instead of putting all your money into one stock, one sector, or even one asset class, you spread it out. Think of it like this. You wouldn't want your entire net worth tied up in just one company, right? Because if that company goes belly up, you're in trouble. But if you have your money spread across different sectors like technology, healthcare, real estate, and international markets, even if one area takes a hit, the others can help cushion the blow. Diversification is key to managing risk and protecting your investments over the long haul. Now, if you're looking for a bit more stability in your portfolio, blue chip stocks are worth considering. These are the big, well-established companies that have been around for decades. Think Apple, Amazon, Johnson & Johnson, Coca-Cola, you know the names. Blue chip companies tend to have a long history of solid earnings, a strong track record of paying dividends, and a reputation for weathering economic storms. They're like the reliable, steady Eddie investments in your portfolio. Now, I'm not saying blue chip stocks are completely immune to market downturns, because nothing is, but they're generally considered to be less volatile than smaller, newer companies. They're the kind of companies you can feel confident holding on to for the long term. Chapter 4. Use dollar cost averaging. Okay, let's talk about one of my favorite investing strategies. Dollar cost averaging. It's a fancy way of saying invest consistently over time. Here's the basic idea. Instead of trying to time the market, which is nearly impossible to do consistently, you invest a fixed amount of money at regular intervals, no matter what the market is doing. So let's say you decide to invest $500 every month into an index fund. Some months the market might be up and you'll buy fewer shares. Other months the market might be down and you'll buy more shares. Over time, this strategy helps you average out the cost of your investments, reducing the impact of market volatility. It takes the emotion out of investing and helps you stay disciplined. Here's a pro tip for you. Reinvest your dividends. Dividends are like little bonus payments that some companies give to their shareholders. When you reinvest those dividends, you're essentially using that money to buy more shares of the company's stock. It's like a snowball effect for your investments. Over time, those reinvested dividends can really add up, especially when they're compounded over many years. It's like earning interest on your interest. Think of it this way. The earlier you start reinvesting dividends, the more time those dividends have to grow and compound, potentially leading to a larger nest egg down the road. The world of investing is constantly evolving. There are always new trends, new technologies, and new opportunities emerging. That's why it's crucial to stay informed and continuously educate yourself about the market. Read books, listen to podcasts, follow reputable financial news sources, and stay up to date on the latest trends in the industries you're invested in. The more you know, the better equipped you'll be to make informed investment decisions. Remember, knowledge is power, especially when it comes to managing your money. And finally, one of the most important tips for beginners is to set long-term goals for your investments. Investing shouldn't be about trying to get rich quick or chase the latest hot stock tip. It's about building wealth gradually and steadily over time. Before you invest a single dollar, think about what you're saving for. Is it a down payment on a house? Your retirement? Your kids' education? Having clear financial goals will help you stay focused and motivated, even when the market gets bumpy. Remember, investing is a marathon, not a sprint. So there you have it, guys. 7 of my best tips for anyone looking to start investing in the stock market. Remember, the key is to start small, stay consistent, and think long-term. Don't get discouraged by short-term market fluctuations or feel overwhelmed by the sheer volume of information out there. Just take it one step at a time, and you'll be well on your way to building a brighter financial future. Thanks for watching. If you found these tips helpful, don't forget to like, subscribe, and hit the notification bell for more investing advice. Happy investing!